Hello everyone. In previous video, we were covering chapter 8 of the financial education part. So we will resume the chapter, that is chapter number 8. So the next topic we have is different types of loan available. So the banking institutions provide various types of loans to individuals and business communities, such as there are different types of loan like personal loan, vehicle loan, education loan, gold loan, housing loan, agriculture loan, and consumer durable loans. So personal loan is a loan that can be utilized for any purpose, for example, paying debt, marriage expenses, or vacation expenditure. No collateral security is required for this type of loan. Vehicle loan. This loan is issued for the purpose of purchasing new or second-hand vehicles for personal and commercial uses. Education loan. Education loan is required for students and family to meet the financial goal of higher education. Students should have an admission offer from an institution before they apply for education loan. Gold loan. Gold loan is given only on providing gold as a security to a bank or any other lending institution. Housing loan. Housing loans are taken by people for a variety of house-related purposes, such as construction of a house renovation, extension of house, buying of property or land, etc. Agriculture loan. Agriculture loans are provided to farmers to fund agricultural operations or related activities like horticulture, sericulture, etc. Consumer durable loans. Consumer durable loans are the loans which may be availed for purchasing of consumer durables like television, refrigerator, etc. The 5 C's in credit. One-stop guide to get your loan sanctioned. The banks generally follow a conservative approach for processing the loan request of the borrowers. In this analysis, banks consider 5 elements, and these are known as 5 C's in credit. These are as follows. The first one is capacity. Capacity, character, capital, collateral, and conditions. So, in capacity, the prospective lender will want to know exactly how you intend to and what is your capacity to repay the loan. In character, the lender will form a subjective opinion as to whether or not you are sufficiently trustworthy to repay the loan or generate a return on funds invested in your company. In capital part, capital is the money you personally have invested in the business and is an indication of how much you have at risk should the business fail. Collateral. Banks insist on taking a security in addition to that is created out of loan proceeds. Conditions. Banks analyze the intended purpose of availing the loan, like will the money be used for working capital, additional equipment or inventory, among others. Then we have is credit score. So the credit information agencies play a vital role in decision making in loan application process. After an applicant fills out the application form and hands it over to the lender first checks the credit score and credit report of the applicant. If the credit score is low, the lender may not even consider the application further and reject it at that point. If the credit score is high, the lender will look into the application and consider other details to determine if the applicant is credit worthy. The credit scores works as a first impression for the lender. The higher the score, the better are your chances of the loan being reviewed and approved. The decision to lend is solely dependent on the lender, and credit score or credit reports does not in any manner decide if the loan or credit card should be sanctioned or not. Credit Information Bureau Limited is India's first credit information company, also commonly referred to as Credit Bureau. CIBIL collects and maintains records of individuals and non-individuals like commercial entities, payments pertaining to loans and credit cards. These reports are submitted to CIBIL by banks and other lenders on a monthly basis. Owning this information, a credit information report, that is CIR, and credit score is developed, enabling lenders to evaluate and approve loans and applications. A credit bureau is licensed by the RBI and governed by the Credit Information Companies Regulation Act of 2005. The Reserve Bank of India requires all credit bureaus to give one free full credit report every year to all consumers. What are the tips to avoid debt trap? Tip number one is debt can be managed with the right mindset and discipline. Do not buy more than what you can afford. Do not get lured into want items. So what are the want items? Want items. Want items are those items that a person does not require. Right. Tip number two is getting the maximum mortgage loan tenure does not necessarily mean we need to take as long to repay. Tip number three, realize that cards should only be used to facilitate payments and not as a means to borrow money. Tip number four is never treat credit cards as free money. Tip number five is stop all the activities that result in debt. Change your lifestyle to accumulate more savings. Tip number six is use a debit card instead of a credit card. It eliminates the risk of spending beyond your means. Tip number seven, spend within your means. Buy things you can afford to pay. Chapter number nine is government schemes for various savings and investment options. First one is government schemes. We will cover government schemes first. Government of India accepts deposit from the public, and some of them are also tax saving instruments like National Savings Certificate, Kisan Vikas Path, Post Office Savings Certificates, Sukanya Samriddhi Deposit, PPF, etc. are some of the examples of various schemes run by the Government of India. These schemes may have different durations for investment and carry specific interest rates. The detail of the latest schemes are as follows. So first we will cover Sukanya Samriddhi Yojana. What is the objective? Objective is to promote the welfare of a girl child. Who can open the account? A natural or legal guardian on behalf of a girl child where child's age is 10 or less. Maximum number of accounts up to two girl children or three in case of twin girls as second birth, or the first birth itself results in three girl children. Tax education, deduction as applicable under Section 80C of the Income Tax Act 1961. Premature closure allowed in the event of death of the depositor or on compassionate grounds such as medical support in life-threatening diseases and is authorized by an order of the Central Government of India. Irregular payment or revival of account by payment of penalty amount. Mode of deposit is cash, check, demand draft, digital payment. Withdrawal: a certain portion of the balance lying in the account as at the end of the previous financial year for the purpose of higher education and marriage after attaining the age of 18 years. Pradhan Mantri Jan Dhan Yojana. So the objective is that it is launched in August 2014 by Government of India to ensure financial inclusion of every individual who does not have a bank account in India, to provide access to financial services, namely banking, savings and deposit account, remittance, credit, insurance and pension in an affordable manner to all. Accounts can be opened with any bank branch or business correspondent or bank niti. Facilities provided with the account opened are zero balance account, RuPay, debit card, and accidental insurance cover and a life cover of certain amount with the payment on the death of the beneficiary. It is also subject to conditions. Overdraft facility up to a certain amount. This facility is available against one account per household. Mobile banking facility for checking balance and transferring funds with ease across India. Interest earned on the deposits, not mandated to have a minimum balance in the account. Direct benefit transfer for beneficiaries of government schemes. Easy access to pension and insurance products. To get a checkbook, the individual will have to fulfill minimum balance criteria. Overdraft is a facility available to bank customers wherein they can take a short-term loan from bank to meet their urgent requirements, with promise to pay back the same amount in the timelines agreed between the bank and the customer. Basic insurance schemes run by Government of India. First one is Pradhan Mantri Suraksha Bima Yojana. So it provides accidental insurance cover to bank account holders in the age group of 18 to 70 years. It is a fixed annual premium. A fixed annual premium is deducted from the bank account of the insured through auto debit facility. A person would be eligible to join the scheme through one savings bank account only, and insurance covers permanent and partial disability due to accident. Pradhan Mantri Jeevan Jyoti Bima Yojana provides life insurance cover to bank account holders in the age group of 18 to 50 years. A fixed annual premium is deducted from the bank account of the insured through auto debit facility. Person would be eligible to join the scheme through one savings bank account only. Pradhan Mantri Jan Arogya Yojana or Ayushman Bharat. It provides healthcare facilities targeting poor, deprived rural families and identified occupational category of urban workers families. There is no restriction on family size, age or gender. All members of eligible families as presenting SECC, that is Socio-Economic Caste Census 2011 database, are automatically covered. No money needs to be paid by the family for treatment in case of hospitalization. All pre-existing conditions are covered from day one of the policy. The benefit cover will include pre and post hospitalization expenses. You can go to the public or and panel private hospitals across the country and get free treatment. Pradhan Mantri Fasal Bima Yojana. It is a crop insurance scheme aimed at shielding farmers from the crop failure through insurance. In the event of a crop loss, the farmer will be paid based on the difference between the threshold yield and the actual yield. The threshold yield is calculated based on average yield for the last 7 years, and the extent of compensation is set according to the degree of risk for the notified crop. The scheme is compulsory for farmers who have availed of institutional loans. The scheme insures farmers against a wide range of external risk like droughts, dry spells, floods, uh, inu- inundation, pests and diseases, landslides, natural fire and lightning, hailstorms, cyclones, typhoons, tempests, hurricanes and tornadoes. The scheme covers post-harvest losses up to a period of 14 days. Other saving or insurance schemes run by Government of India. Uh, First one is Kisan Vikas Patra. Kisan Vikas Patra is a small savings certificate scheme from India Post designated to double the investment after a predetermined time. Objective is to inculcate long-term financial discipline in people. The minimum amount for opening is 1000 rupees and in multiples of 100 rupees. No maximum limit. Certificate can be purchased by adult and also minors above 10 years of age, and it can be purchased from any post office. Public Provident Fund. That is PPF. So PPF is a tax-free savings scheme offered by the government of India. PPF account can be opened with either a post office or with any nationalized or private bank. A joint account cannot be opened, and only one account can be opened by a citizen in India, along with nomination facility. Investments made in the PPF account during a particular financial year are available to claim deductions under Section 80C of Income Tax Act up to a certain limit. Investors can also avail loans against a particular amount of their investments made in PPF account subject to other conditions of the scheme. National Savings Certificate (NSC), a Government of India initiative primarily to invest while savings on income tax, can be opened from any post office, and NSCs will be issued in shape of passbook. Joint accounts are allowed, and it can be opened by an adult or on behalf of a minor. Deposits qualify for tax rebate under Section 80C of Income Tax Act. Pension schemes run by Government of India. So the pension scheme we have is Atal Pension Yojana or APY. Pension-oriented savings schemes focused on the citizens in the unorganized sector. It may be opened for all bank account holders. Objective is to provide a fixed amount of pension to unorganized sector workers who find no coverage under any other social security schemes. Minimum age of joining the APY is 18 years and maximum age is 40 years. Exit before 60 years is not generally permitted except for in the event of death of the beneficiary or a terminal disease. However, the spouse can continue with the scheme after the death of the beneficiary. Borrowing related schemes of Government of India. First one is educational loans through Vidya Lakshmi portal. Objective is to provide easy and effective system of getting educational loans so that no student leaves his or her education midway due to lack of funds. The web address of the portal is www.vidyalakshmi.co.in. The students get information about educational loan schemes of banks. Common educational loan application form is available for students. There is a provision to apply to various banks for educational loans through a single form. The site is linked to the National Scholarship Portal for information and to apply for government scholarship. The student can view the status of their loan application at any time and at any place with an easy access to the dashboard facility of the website. Prime Minister Awas Yojana. So it is a credit-linked subsidy scheme for lower-income groups or economically weaker section and middle-income groups. Individuals are eligible to avail subsidy through this scheme only when they are purchasing their first house or it is a new construction. In case a family has already availed of central assistance under any housing scheme in the past, or they already own a house in India, either in their name or in the name of a family member, or their spouse is also claiming interest subsidy for a house, then they will not be eligible to avail subsidy under this scheme. Property purchased needs to be in compliance with the guidelines as prescribed by the scheme from time to time. Pradhan Mantri Mudra Yojana. So it is a government of India scheme that offers business loans to proprietors or entrepreneurs of small and medium enterprises. This loan schemes offered under Siso, Kishore and Tarun. There are three categories here and it is depending on the amount of loan available. Eligibility is that the borrowers must be from the following non-corporate small business segments: proprietorship, partnership firms, small manufacturing units, service sector units, shopkeepers, fruit or vegetable vendors, truck operators, food service units, repair shops, machine operators, small industries, food processors, other industries in rural, rural and urban areas. Key documents required to avail such loans are proof of identity, quotation of items purchased, and category certificates. The next scheme we have is Stand Up India. So this is scheme for financing SC, ST, and for women entrepreneurs above 18 years of age. Objective is to facilitate bank loans to the above mentioned target groups. Purpose of loan is for setting up a new enterprise in manufacturing, trading, or private sector. Chapter 10. Chapter 10 is tax saving options. So income tax is that percentage of your income that you pay to the government so that it can fund its many expenses such as infrastructural development, pay the salaries of those employed by the state or central governments, etc. All taxes are levied based on the passing of a law, and the law that governs the provisions of our income tax is the Income Tax Act, 1961, as amended by subsequent Finance Acts. Income tax has to be paid by every individual person, Hindu undivided family, that is HUF, association of persons, body of individuals, corporate firms, companies, local authorities, and all other artificial judicial persons that generate income. Taxes are calculated on the annual income of a person and an annual cycle as per the income tax law. Starts on the 1st of April and ends on 31st of March of the next calendar year. The law recognizes and classifies the years as previous year and assessment year. The year in which income is earned is called the previous year, and the year in which it is charged to tax is called the assessment years. So there are multiple deductions that are allowed under the income tax act. First one is section 80C. So 80C deduction for money invested in life insurance, provident fund, ELS schemes of mutual fund, special bank deposits of 5-year term, contribution to NPS account, tier 1 account only, national savings certificate, principal repayment of housing loan, etc. Section 80 CCD or post funding. In addition to reduction claimed under Section 80C, investment in NPS by any individual is available for claiming deduction under the 80 CCD 1B of the IT Act. Amount available for deductions under this scheme is over and above the amount available for claiming deduction under Section 80C of IT Act. Section 80D. Individuals are eligible to claim deductions for medical insurance availed for self, spouse, dependents, and dependent parents and dependent children. Section 80G. The donations to National Children Foundation, university, or educational institutions of national importance, Prime Minister's Relief Fund, charitable institutions, etc., are deductible from the taxable income. Section 80 TTA. Interest on savings account is taxable. However, tax charged on interest earned on savings bank account is eligible to be claimed as a deduction under Section 80 TTA, subject to limits on the amount claimed as deduction and other conditions specified from time to time. It is available only to individual or Hindu undivided family. It is applicable for savings bank account, post office, or cooperative banks. Next section is section 24. So the interest paid on housing loan availed for purpose of acquisition of property, construction of property, or repair of property. It is applicable on housing loans availed after 1st of April 1999. The last date to file income tax returns or for an individual is 31st of July of each financial year. However, the relevant dates for filing income tax returns and other deductions and details related to income tax act are subject to change. Therefore, readers are advised to regularly check latest provisions and guidelines issued by government from time to time. Chapter 11 Caution against Ponzi schemes and unregistered investment advisors. Ponzi schemes. Ponzi schemes are named after Charles Ponzi, who constructed one such scheme at the beginning of the 20th century. Of course, the concept was well known prior to Ponzi's rise to infamy. A Ponzi scheme is a fraudulent investment scheme promising high rates of return to investors. The scheme generates returns for earlier investors from their own money or money paid by subsequent investors, rather than any actual profit earned. The perpetuation of the returns that a Ponzi scheme advertises and pays requires an ever-increasing flow of money from investors to keep the scheme going. The Ponzi scheme usually attract new investors by offering returns that other investments cannot guarantee, in the form of short-term returns that are either abnormally high or unusually consistent. As more investors become involved, the likelihood of the scheme coming to the attention of the authorities increases. It has been the typical experience that promoter then vanishes, taking all the remaining investors' money. Such schemes typically collapse under their own weight as fresh investments slow down and promoters start having problems paying the promised returns. The system is destined to collapse because the earnings, if any, are less than the payments to investors. Sometimes the authorities are able to clamp down on such schemes before they collapse because they act on suspicion of a scheme being a Ponzi scheme. How to spot one? Here are few tips that help you spot a Ponzi scheme. It has high returns with little to or no risk. Every investment carries some degree of risk. Higher the return, higher the risk is involved. Be highly suspicious of any guaranteed high return investment opportunity, and it overlay consistent returns. Investments tend to go up and down over time. Be skeptical about an investment that regularly gives positive returns regardless of overall market conditions. Unregistered investments. Ponzi schemes typically involve investment schemes that are not registered with the regulators or any government agency for their activity. Registration is important because it provides investors with access to information about the company's management, products, services, and finances. Unlicensed sales. Any investment schemes that requires to be registered with concerned authority and the state securities laws require investment professionals and firms to be licensed or registered. Most Ponzi schemes involve licensed individuals or unregistered firms. Non-transparent disclosure. Avoid investments if you don't understand them or can't get complete information about them. Account statement errors may be a sign that funds are not being invested as promised. Difficulty in receiving payments. Be suspicious if you don't receive a payment or have difficulty cashing out. Ponzi scheme promoters sometimes try to prevent participants from cashing out by offering even higher returns for staying invested. Structure of Ponzi or pyramid schemes. So in the bottom we have multiple investors, and on top we have one mastermind behind the Ponzi scheme. So investment has been successful in the first few months, convinces more investors to place their money in the system. Then, since investors receive money on the first money, news started to spread and recruitment follows. The schemer promised investors a return on investment for each month that their money is invested in the firm. When funding runs out, the scheme collapses. Protection from fraud. Recently in India, many of the investors lost money because of the operation of unregistered entities offering investment schemes. The Sarda chit fund scam in West Bengal and the illegal mobilization of funds by Sahara firms are relevant examples. One needs to be caution himself or herself about the operation of fraudulent agencies luring investors by offering higher returns within a short period. You can keep your money safe by being aware of these risks. There are different types of fraud. So first one is mass marketing fraud. You receive a fraudulent email that looks like it comes from a legitimate company, asking you to click on a link that brings you to a fake website. To be safe, never invest, donate, or make purchases on the phone unless you can validate the company's existence. Investment fraud. Sometimes recruits, sometimes someone recruits you to a company in a business to buy merchandise to sell. You are expected to recruit new members. After a while, new people stop joining. That's when the promoters vanish, taking your money with them. Lottery scam. Congratulations, you have won the lottery sweepstakes big prize. All you have to claim your prize is send a small fee or tax payment. Legitimate contest. Don't charge fees for you to collect your prize. Credit card and credit and debit card fraud. Credit card and debit card fraud happen when someone uses your card information, or personal identification PIN without your permission. Never share your PIN with affinity fraud. Fraudsters can win your trust more easily if you have part of a group of people who share a common cause, such as a religious or social organization. Scammers may ask investors to keep the matter private. Tip number one is never fall for a deal that is too good to be true. If you do not understand what the product is all then how you invested, do not buy. Tip number two is do not invest in unfamiliar products just because the returns appeal to you. Do thorough research on the company's background and financial information. Weigh your risk appetite against the product that you are investing. Caution against unregistered investment advisors. SEBI registers investment advisors under SEBI Regulations 2013, last amended on 3rd of July 2020. Investment advisor means any person who, for consideration, is engaged in the business of providing investment advice to clients or other persons or group of persons, and includes any person who holds out himself as an investment advisor by whatever name code. The aim of the regulation is to regulate investment advice, which refers to advice relating to investing in purchasing, selling, or otherwise dealing in securities or investment products, and advice on investment portfolio containing securities or investment products, whether written, verbal, or through any other means of communication for the benefit of the client, and shall include financial planning, provided that investment advice is given through newspaper, magazines, any electronic or broadcasting or telecommunications medium, which is widely available to the public, shall not be considered as investment advice for the purpose of these regulations. Investment advisors are supposed to obtain registration from SEBI and follow the code of conduct. It is illegal to act as investment advisor without SEBI registration. SEBI is making concerted efforts to stop such illegal activities. Some unscrupulous and ignorant entities may not get themselves registered and or may not follow the code of conduct. Investment advisors have to limit themselves to giving advice in case of cash or securities. Some of the malpractices in connection with the activities of registered and unregistered entities acting as investment advisors, as reported to SEBI, companies of the following: SEO returns being offered by the investment advisors to the clients, charging exorbitant fees from clients with a false promise of handsome returns, mis-selling by investment advisor without adhering to the risk profile to the client to earn higher fees. On receiving complaints for refund of fees complaints for loss incurred, investment advisor offer higher risk products to clients with a promise that they will recover their losses. Trading on behalf of clients, automatically upgrading or changing the service to higher risk products not matching with the client profile and without the consent of the client. Poor service by the investment advisor causing loss of money to the client. Refund related issues. Investors therefore need to be aware and guard themselves against above-mentioned practices present in the market and deal with caution with entities claiming expertise in capital markets. Investors are advised to take advice for investment only from entities registered under SEBI Regulations 2013, last updated on 3rd of July 2020. So, what are the do's and don'ts while dealing with investment advisors? Uh, First, we will read out the do's, then we will cover the don'ts. So, always deal with a SEBI registered investment advisor. Check for SEBI registration number. The list of all SEBI registered investment advisors are available on SEBI website. Ensure that the investment advisor has a valid registration certificate. Pay only advisory fee to your investment advisor. Make payments for advisory fees through banking channels only and maintain duly signed receipts mentioning the details of your payments. Always ask for your risk profile before accepting investment advice. Insist that investment advisor provides advisory strictly on the basis of your risk profiling and take into account available investment alternatives. Ask all relevant questions and clear your doubts with your investment advisor before acting on advice. Assess both the risk return profile of the investment as well as the liquidity and safety aspects before making investments. Insist on, insist on getting the terms and conditions in writing, duly signed and stamped. Read these terms and conditions carefully, particularly regarding advisory fees, advisory plans, category recommendations, etc., before dealing with any investment advisor. Be vigilant in your transactions. Approach the appropriate authorities for redressal of your doubts, grievances. Inform SEBI about investment advisors offering assured or guaranteed not deal with your unregistered entities. Don't fall for stock tips offered under the pretext of investment advice. Do not give your money for investment to the investment advisor. Don't fall for the promise of assured returns. Don't get greed overcome rational investment advice decisions. Don't get carried away by luring advertisements for market rumors. Avoid doing transactions only on the basis of phone calls or messages from any investment advisor or its representatives. Don't take decisions just because of repeated messages and calls by investment advisors. Do not fall prey to a limited period discount or any other investment incentives, tips, etc. offered by investment advisors. Don't rush into making investments that do not match your risk-taking appetite and investment goals. Chapter 12 is grievance redressal mechanism. Scores, first one is scores. Scores is a short form for SEBI compliance redress system. SEBI launched a centralized web-based complaints redressal system Scores. The purpose of Scores is to provide a platform for aggrieved investors whose grievances pertaining to securities market remain resolved by the concerned listed company or registered intermediary after being approached directly. Whenever an individual faces an issue, he or she has to first contact his or her exchange or broker for filing his complaint. If he is not satisfied with the resolution provided to him or has not received any response from his concerned company, exchange or broker where he has filed his complaint, then he can directly file his complaint on scores. For filing a complaint on scores, you may either access scores.gov.in or download scores mobile application. An investor may lodge complaint on his scores within 3 years from the date of close of complaint. In case an investor fails to lodge a complaint within the stipulated time, he may take it up with the entity concerned or in the appropriate court of law. You have to first register on scores before lodging your complaint. If you already have a username and password, then click on the register or login to lodge complaints. If you are a first-time user, then click on the register here under the title Not Registered Yet and enter your personal details such as name, address, and mobile number. Then you will have to select a category among the following options: listed companies, registrar and transfer agents, brokers, stock exchanges, depository, participants, depository, mutual funds, other entities, and inclusive. Now you should enter specific details of the complaint in the specified category. After the data is entered in all the headings, you may file your complaint by confirming the same. The complaint is then examined by SEBI to see if the subject falls under its purview. If it does, SEBI forwards it to the concerned entity with an advice to send a written reply to the minister and file an action taken report within the stipulated timelines. Supporting documents up to 2 MB can be attached in the PDF format in case the data to be uploaded for each category is more than 2 MB. It can be sent by post to any CB office. Registration number. On filing the complaint, a unique registration number will be generated, which can be used for future communication. An email with the complaint registration number will also be sent to the email ID added in the complaint registration form. View complaint status. You can check your complaint status while logging into your account. In case of physical complaints, sent to SEBI. Enter the password sent to you by SEBI in the acknowledgement letter, and then you can check your complaint. Before using scores, you should try to contact the person or company that is the cause of your complaint. You might be able to resolve your problem more quickly by speaking to them directly rather than waiting for a response to your complaint. Matters that are not considered as complaints in scores. Complaints, those are incomplete or not specific. Allegations without supporting documents or offering suggestions or seeking guidance or explanation, seeking explanation for non-trading of shares or illiquidity of shares, not satisfied with the trading price of the share price of the companies or non-listing of shares of private offer, disputes arising out of private agreement with companies. What is the SEBI Scores mobile application? This is an interface of the SEBI Scores mobile application. So SEBI has launched Scores mobile app to facilitate the investors to lodge their grievances at the convenience of their smartphones. The app has all the features of Scores, which is presently available electronically, where investors have to lodge their complaint by using internet. After mandatory registration on the app for each grievance lodged, investors will get an acknowledgement via SMS and email on their registered mobile numbers and email ID respectively. Investors can not only file their grievances but also track the status of their complaints. Investors can also key in reminders for their pending grievances. Investors can access the FAQs on scores for better understanding of the complaint handling process. Connectivity to the SEBI toll-free number has been provided from the app for any clarifications or help that investors may require. The mobile app SEBI Sports is available on both iOS and Android platforms. SEBI Helpline. It is a toll-free helpline service for investors to facilitate replies to various queries of the general public on matters relating to securities market. SEBI has undertaken a new initiative and launched toll-free helpline service numbers. The toll-free helpline service is available to investors from all over India in both languages. The toll-free helpline service is available on all days from 9:30 a.m. to 5:30 p.m. There are some guidance pertains to the following. The following services or answers to questions are provided to the investors on the toll-free helpline number. Status of companies like whether unlisted, SIG, or delisted or liquidated or wound up, etc. Change in names of companies pursuant or amalgamation or merger or demerger, etc. Details of registrar and share transfer agent (RTA) of a listed company. Details and information on names and addresses of various registered intermediaries of SEBI. Where to get information on regulatory action taken by SEBI. Where to get information on corporate action like dividend bonus, rights issue, etc. Where to get latest net asset value for a mutual fund scheme. How to lodge a complaint with SEBI. Against whom to lodge a complaint on scores. Status of complaint lodged with SEBI. Names and addresses of various registrar of companies, official liquidators, national company law tribunal, NCLT, etc. The regulators or authorities whom the investor has to approach for redressal of their grievances that are not under SEBI purview. For example, RBI, BRB, PFRDA, and MC. Assistance in procedures is like how to open a demat or client account, etc. Transfer of shares, transmission of shares, documents required for transfer or transmission of shares, information on what to do if shares are lost, forged, or fake, procedure for applying for duplicate shares, how to apply in your names and address of companies who have filed their office offer documents with CV. The helpline service doesn't offer any legal opinion or investment advice to the investors. So this is how the Indian retracer or securities market work. So whenever a securities or market related complaints or fraud are happen, so they will approach the concerned company. If they are satisfied, then it is fine. If they are not satisfied, then they can approach the SEBI for that. They can also lodge online complaint or they can also call on toll-free number. Grievance redressal banking industry. Banking related complaints or fraud. They can approach your bank. You can also approach your bank and contact the branch manager. If reply from the bank not received within 1 month, or the bank rejects the complaint, or the complaint is not satisfied, complainant is not satisfied with the reply, then they can approach the banking ombudsman. For that, they can also apply. They can also apply in writing for the same. This is the mechanism of grievance redressal in insurance industry. So whenever an insurance related complaint or fraud, then they can approach IRDAI grievance call center or IGNS portal. Then the IGNS portal will reach out to insurer. If it does not respond, and if it responds to complaint, if the answer is not satisfactory, then the ombudsman or consumer forum civil court will take up the case. If it is satisfactory, then the case will be closed. This is the grievance redressal mechanism for pension industry. So whenever a pension related complaints or fraud happen, then they can approach PFRDA where they can apply either online or they can call on the toll free number or they can also apply in writing to the PFRDA. These are the different grievance redressal agencies. So if there is a mobilization of deposits by non-banking finance companies, then the RBI will look at the case. If it is a Nidhi or mutual fund benefit society, then also the RBI will take up the case. If it's a gold saving schemes linked by jewelers, then MCA or RBI will take up the case. If the deposits accepted by companies under Section 73 of the Companies Act, then the Ministries of Corporate Affairs will take up the case. If the schemes offered by cooperative societies, then the state governments will take up the case. If it's a cheap fund business, then the state government will take up the case. If it is a multi-level marketing pyramid marketing schemes, then the state governments will take up the case. If it is a contract of insurance, then the Insurance Regulatory and Development Authority of India, that is IRDI, will take up the case. If it is a unit plan, that is a unit linked insurance plan, then also IRDI will take up the case. If it is a pension scheme or insurance scheme framed under APF, then the PFRDA or the IRDA will take up the case. If it is a new pension system, then the PFRDA will take up the case. If it is a housing finance institutions, then the National Housing Bank will take up the case. And if there are some grievances against companies, intermediaries, and securities market, then the SEBI will handle the case. Chapter 14 about SEBI. So, Securities and Exchange Board of India (SEBI) is a statutory body set up by the Parliament of India in 1992 to protect the interests of investors and develop the Indian securities market. It started operations in 1988 through an order of Government of India. The key functions of SEBI are focused upon development of Indian securities market, regulation of various intermediaries in the securities market, and protection of the interest of investors. It is headquartered in Mumbai with the regional offices in Delhi, Kolkata, Chennai, and with various local offices across different states. The buying and selling of shares takes place in the stock exchange through stockbrokers. These intermediaries in securities market can function only if they are registered with SEBI, and they are also required to follow the rules, regulations, and guidelines laid down by SEBI to protect the investors. Similarly, SEBI also regulates other participants in the capital market, stock exchange, brokers, depository participants, portfolio managers, market makers, share transfer agents, etc. The mutual funds collect money from different investors and then invest that money in various schemes as per the choice of investors. They are governed by rules formulated by SEBI. Mutual funds have to disclose details of the scheme where they will invest money, the fees charged from the investor, etc. They also have to make periodic disclosures for the benefit of investors as mandated by SEBI. SEBI also educates investors and facilitates redressal of their grievances. So this is a feedback form of the financial education that we just studied. So let's start with some questions. Here we can enter our name, the age. Question number 3 is: has your knowledge about personal money management improved after reading this booklet? You can answer the questions in yes or maybe option. So let's answer some of the questions here. So we can definitely tick the yes. Do you feel that after the completion of this booklet, you will refine your investment strategy? It is definitely yes. Will you take risk for better rewards? Uh, Maybe we can take the risk for better rewards. Will you diversify your investments as part of risk management? Definitely yes. Will you buy mutual fund units? You already have mutual fund units. Will you track your investment regularly? It is yes. What is the plan to achieve your retirement purpose? These are some long form answers that we can answer here. These are the some financial education and investor awareness initiatives of the SEBI. First one is resource person programs. So financial education programs conducted by SEBI and panel resource person in tier 2, tier 3 cities, towns in their local language for various target groups like retired persons, homemakers, self-help groups, or working executive, etc. Uh, there is also an option to visit or buy SEBI programs. Investor awareness programs conducted for students from college, schools, and professional institutes who visit SEBI offices for these programs. SEBI officials also visit various educational institutions, addressing the students and creating awareness about securities market. Regional seminars, investor awareness programs conducted by SEBI in coordination with stock exchange, depositories, commodity derivative exchange, etc. We can also have investor awareness programs through investor association. So investor awareness programs in securities market conducted by SEBI request investors associations, tier 2, tier 3 cities and towns. One more program we have is investor awareness program through commodities derivatives trainers. It is also called CUTs. So the investor awareness programs in commodities derivatives conducted by SEBI recognized commodities derivative trainers or COTs in tier 2, tier 3 or tier 3 cities and towns. Last one is awareness program through securities market trainers, where the investor awareness programs in securities markets conducted by SEBI recognized securities market trainers, uh, which is short form for SMARTs, in tier 2, tier 3, and tier 3 cities and towns. So this is the end of the financial education part. So this is end of the part 3. Thank you.